Good morning, good afternoon, and good evening. Welcome to the ACAD Reader's Briefing, the podcast that turns a full issue of a major magazine into a focused 30 to 60-minute audio briefing. Today, we are bringing you a reader's guide to the August 3rd, 2026 issue of Barron's. The cover features a yellow pill beneath a crown with the words "The Everything Drug" printed across it. The cover story follows the rapid evolution of GLP-1 drugs. Once known primarily as obesity injections, these treatments are now developing into a potential platform for addressing a much wider range of diseases. At the center of this contest are Eli Lilly and Novo Nordisk. Their products, manufacturing capacity, insurance coverage, and returns on invested capital are all becoming part of the same global race. Above the main cover image, another headline delivers a second important message. Spending on artificial intelligence is finally beginning to pay off. This issue revolves around 5 major questions. First, how are GLP-1 drugs moving beyond obesity injections and becoming a treatment platform for many different diseases? Second, artificial intelligence capital spending has begun to generate real profits. But could weakness in the technology trade still pull down the wider market? Third, what would happen if the Panama Canal, the Strait of Hormuz, and the Bab al-Mandeb Strait were constrained at the same time? How would the resulting disruption move through global shipping routes and create new inflationary pressure? Fourth, how will the Federal Reserve's messaging, United States policy toward Iran, Meta's capital spending, and forced selling by a highly leveraged fund affect investor confidence in leadership and policy credibility? And fifth, short-term United States Treasuries now offer yields close to those available on long-term bonds. Can investors increase their income without taking on significantly more risk? Taken together, the articles in this issue describe an investment environment shaped by several powerful forces moving at once. Artificial intelligence capital expenditure is beginning to produce measurable profits. GLP-1 drugs are expanding from a category of obesity treatments into a broader medical platform. At the same time, shipping disruptions, interest rates, corporate cash flow, financial leverage, and policy credibility are changing the way investors must assess risk. The central message is clear. Promising technologies may create enormous opportunities, but returns will depend on execution, production capacity, financing conditions, and the ability of companies and policymakers to maintain confidence. Next, let us turn to the individual article briefings in today's issue.
Section 1. Healthcare. 1.1. The next wave of GLP-1s is coming. They'll treat a lot more than obesity. GLP-1 drugs are moving from obesity injections toward a treatment platform for many diseases. Insurance coverage is widening, pills are adding new delivery choices, and researchers have studied their use in sleep apnea, heart disease, kidney disease, Alzheimer's disease, asthma, and cancer risk reduction. The market remains a duopoly. Eli Lilly leads with tirzepatide, while Novo Nordisk holds the early advantage in pills. Morgan Stanley raised its 2035 sales forecast for diabetes and obesity to $190 billion. In a key trial, Lilly's retatrutide produced an average 28% loss of body weight after 80 weeks, while later amylin drugs aim to burn fat and preserve muscle. Patents, manufacturing capacity, and free cash flow point to years of further growth for both companies.
Section 2. Global Trade and Supply Chains. 2.1. El Niño may curb trade. Two major shipping lanes were already badly obstructed by the Iran war, and the Panama Canal was preparing to reduce capacity because of El Niño. The probability of a severe El Niño rose from 25% to 81%, while the previous episode cut daily canal traffic from 36 vessels to 18 at times. About 12% of U.S. goods trade uses the canal. If the Strait of Hormuz, the Bab el-Mandeb Strait, and the Panama Canal are constrained together, shipping time, insurance costs, and effective capacity will all come under pressure, and a new round of inflation could come sailing into view.
Section 3. Market Strategy and Risk. 3.1. How the tech trade could still sink the market. The stock market has begun to doubt everything it once held true. Artificial intelligence earnings remain strong, and second quarter S&P 500 profit was expected to rise by more than 27%. But growth is highly concentrated. Capital expenditure is rising, free cash flow is falling. 2-year Treasury yields have moved higher, and inflation and political risks are building. Alphabet beat earnings forecasts, yet fell after lifting artificial intelligence spending and reporting negative free cash flow. Investors are moving from pricing in promise to pricing in execution, so the focus is shifting from who spends the most to who generates measurable returns. 3.2. The market survives a white-knuckle week. Federal Reserve Chair Kevin Warsh used contradictory answers to explain why rates were left unchanged, and the market response looked like a central bank inflation credibility shock. U.S. policy toward Iran met as higher capital spending and forced sales from the leveraged Situational Awareness Fund pushed leadership and financing risk to the front. Stocks still rose slightly for the week, but the nervousness was palpable. The column also found that long bonds can beat stocks during sustained deflation and disinflation, while Airbnb was adding hotels, experiences, and other services as short-term rental regulation tightened, hoping to become an Amazon for travel and living.
3.3. Where to find global bargains with dividends. A great technology is not automatically a good investment. RuPaul Bonsali looks for leading-edge capabilities without NASDAQ-like valuations. Her examples included Edenred and GTT in France, Coloplast in Denmark, Fuyao Glass in China, B3 in Brazil, and United Parcel Service and Virtue Financial in the United States. These companies offered some combination of lower valuations, strong balance sheets, and bankable dividends. She also warned that high operating leverage and high financial leverage can reinforce each other in the artificial intelligence trade, and that investors must not price cyclical earnings as though they were structural. 3.4. Hedging against an AI drop with a collar trade. Alphabet reported negative free cash flow of $5.9 billion and sharply reduced its third quarter free cash flow guidance, pushing the artificial intelligence trade into a show-me phase. A worried shareholder can sell a call option with a higher strike and buy a put option with a lower strike and the same expiration. The caller exchanges part of the upside for downside protection and can keep the initial cost low, but it does not remove every risk. It cannot answer whether artificial intelligence projects will succeed. It only limits part of the price risk while investors wait for cash flow and capital returns to be proved.
Section 4. Macroeconomics and Monetary Policy. 4.1. Warsh's Fed changes the landscape for bond investors. Short-term bond yields already reflect the possibility of Federal Reserve rate increases. The 2-year Treasury yielded about 4.25%, more than 3-month bills and money market funds, and almost as much as longer bonds, while taking far less interest rate risk. The U.S. Treasury 1 to 3-year index had a duration of about 2 years, compared with roughly 6 years for the U.S. aggregate index. The long fixed income bull market may be over, and a higher equilibrium inflation rate and rising federal debt could make rates more volatile. For now, the main opportunities are in shorter-term treasuries and a small number of floating-rate closed-end funds. 4.2. The Fed makes its case for productivity growth. The Federal Reserve called productivity growth strong in its June and July statements, but the data did not yet show that the United States had entered a sustained period of high productivity. Non-farm business productivity rose only 0.3% from the previous quarter in the first quarter of 2026, while total factor productivity declined. Recent gains came mainly from capital expenditure, labor market changes, and business dynamism, and the evidence could not attribute all of them directly to artificial intelligence. Productivity will look like a durable economic feature only when several years, several industries, and revised data all show the same improvement.
Section 5. Personal Finance and Retirement. 5.1. You may need less to retire than you think. Retirement planning faces a distribution of lifespans, not one certain age. The author's estimated chance of living to 95 was only 33%, meaning that a plan built around the software default could produce too much saving. Age, gender, health status, and smoking history can materially change a longevity estimate and therefore change stock allocation, Social Security claiming, and estate planning. Personalized models still carry privacy risks and error, while long-term care, joint life expectancy for couples, and changing spending patterns also belong in the plan. A better estimate is not a reason to spend everything. It is a way to align spending, protection, and legacy goals with personal health and personal wishes.
Section 6. Technology and Artificial Intelligence. 6.1. 5 lessons from an exhausting week in tech, and 2 winners. The week delivered 5 clear lessons. Amazon Web Services, Microsoft Azure, and Google Cloud all beat expectations for revenue and operating margin, showing that massive capital spending was starting to produce real profit. Microsoft's business software did not confirm the bearish case that artificial intelligence would break subscription software, and Microsoft 365 Copilot reached 30 million paid users. Meta still lacked a cloud business that could monetize its data centers directly, while Apple kept a cleaner cash flow profile through lower capital spending. The margin calls at situational awareness also showed that an investor can be right on the fundamentals and still be crushed by leverage. 6.2. Reddit is due for a big AI bump. Forget earnings. Reddit and Google had reached the moment to renew their content licensing agreement. Google reportedly paid $60 million a year to use conversations from more than 100,000 communities to train artificial intelligence models, even as AI overviews diverted search traffic away from Reddit. Authentic human information was becoming scarcer, giving Reddit leverage to demand a larger contract or a usage-based fee. The company also sued Anthropic for scraping data to train Claude. A larger licensing business and a settlement of the lawsuit could improve both earnings and market sentiment.
6.3. The road to AI trading began with ticker tape. Wall Street moved from ticker tape, telegraph lines, railroads, telephones, and trading terminals to the internet, algorithmic trading, and artificial intelligence. Each advance expanded markets, accelerated the flow of money and data, replaced specific tasks, and redefined entry-level work. Artificial intelligence may take over research, due diligence, pitch books, and even complete trading strategies. But training data, model bias, extreme liquidity events, and synchronized exits will still create risk. Once a tool becomes widely available, lasting advantage will not come from owning the technology alone. It will come from data quality, execution, risk control, and distinctive judgment. 6.4. Publicis is winning the AI ad race. Publicis put artificial intelligence, media planning, creative work, and consumer data inside one group. In the second quarter, artificial intelligence-powered marketing services produced 87% of its €3.8 billion in net revenue and grew 6.5% from a year earlier, while client retention remained close to 100%. The company also agreed to buy LiveRamp for $2.2 billion to strengthen data management and advertising measurement. Publicis traded at about 11 times forward earnings and offered a 4% dividend yield. But startups, client-owned technology, and competition from consulting firms could still weaken its lead.
Section 7. Asset Management and Funds. 7.1. It's a bad time to launch new private asset funds. Well-known investment firms launched a new group of private asset funds for individual investors, but the timing was poor. Private credit was under pressure after aggressive lending to technology companies, and many funds had marked down software loans and limited redemptions. In the second quarter, investors asked to withdraw more than $15 billion, but received less than $6 billion. Interval funds and tender offer funds can provide access to private equity, private credit, infrastructure, and real estate, but they do not guarantee that investors can recover all of their money on demand. Long-term opportunity remains, but illiquidity is no longer a theoretical risk.
Section 8. Public Policy and Governance. 8.1. Would you like to be a millionaire? Try running for Congress. Long congressional careers and personal wealth gains had drifted far from the founder's idea of public service. Since 2004, the 100 biggest wealth gainers in Congress recorded an average 114% increase in net worth while in office, while the inflation-adjusted net worth of the median U.S. household fell by nearly 1%. The 2012 Stock Act required disclosure but did not stop members from owning and trading individual stocks. The article called for genuine blind trusts, broad market funds, and term limits so that personal wealth would be aligned with the broader interests of the country.
Section 9. International Markets. 9.1. Vietnam tries to fix stock ownership limits. Vietnam's gross domestic product per person rose almost 40% in 5 years, and exports climbed 60%. Yet foreign ownership limits, capital controls, and outdated market plumbing kept most global funds from investing. The country was increasing spending on ports, railways, and data centers, and was seeking upgrades from FTSE, Russell, and MSCI. Reforms still faced bank scandals, limits on dong convertibility, and the slow work of building institutional trust. Many obstacles appeared to be reflected in prices, and banks, retailers, and steel companies tied to roughly 8% economic growth could offer an alternative to highly valued artificial intelligence stocks.
Section 10. Business and Philanthropy. 10.1. Warren Buffett's worst deal benefits this place the most. Warren Buffett called the 1993 purchase of Dexter Shoe his worst deal because he paid the $433 million price with 25,203 Berkshire Hathaway Class A shares. Those shares would now be worth about $19.3 billion. Harold Alfond, who sold Dexter, and his family used that wealth to support healthcare, education, community development, and the arts across Maine. The Harold Alfond Foundation has given roughly $1 billion in the state. What became a financial disaster for Buffett also became one of the best things that ever happened to Maine.
Section 11. Mailbag. 11.1. Mailbag. Reshoring robots will boost growth. 3 letters focused on reshoring, oil mergers, and the Taylor Rule. Taiwan Semiconductor Manufacturing and Samsung were expanding U.S. semiconductor capacity, and advanced automated factories could create jobs in construction, design, procurement, deployment, and operations. Smaller oil companies could offer takeover value in addition to low valuations and diversification, with APA named as one example. On monetary policy, another letter stressed that John Taylor himself opposed the mechanical use of policy rules. A formula can provide a reviewable benchmark, but it cannot replace judgment when the structure of the economy keeps changing.
Section 12. Company Research and Shareholder Actions. 12.1. Research Reports. These reports were samples of analysts' thinking, not Barron's recommendations. Tigris Financial Partners repeated a strong buy on General Motors and favored its software, artificial intelligence, and defense businesses. Seaport Research rated Lithium Motors a buy after used vehicle profit and expense control lifted earnings above expectations. Susquehanna stayed positive on Cognizant Technology Solutions. Benchmark kept a buy on SiriusXM even though its price target was below the current share price. Texas Capital Securities rated Caesars Entertainment a hold after weaker than expected results on the Las Vegas Strip and in digital operations. 12.2. 13D Filings. The 13D filings showed Tang Capital Management with a 7.9% position in Nano Dimension and a $1.60 a share cash merger proposal. Sevian Capital, too, raised its Smith & Nephew stake to 14.2%. BW Group reduced its position in Navigator Holdings, Bellevue Capital Partners cut Global Net Lease, and Lynrock Lake reduced Radcom. Ownership above 5% does not automatically mean that a takeover is coming. The source of funds, the purpose of the transaction, and the investor's future plans usually say more about the intentions of an activist shareholder or strategic investor.
All right, we are now ready to enter today's main program. Before we do, please like, save, and share this episode so that other people who need it can also see today's content and become better versions of themselves. Thank you. You can now use the timeline in the video description or the pinned comment to find the articles that interest you and listen to them in depth.